Hey, I'm Sage. Welcome to the YouTube channel. And in this series, we're going to be teaching you how to generate wealth long-term in the stock market. You guys are going to be learning strategies that you have never seen before, and you're going to learn how to identify opportunities on every single time frame that exists. If you guys are excited as I am about learning technical analysis and learning these strategies, don't forget to like, comment, and subscribe, and let's dive into the material. Let's get it. All right, everyone, welcome here to the options trading lesson. So this is going to be a more broad-based lesson, I would say. So we want to specifically learn about the ins and outs of option trading, but specifically how it has to deal with in terms of just pricing and then implied volatility. So these are probably the most important things. Going to show you some stuff in the broker. In terms of price action is important. And of course, it's going to be intertwined into what it is that you need to learn in terms of Greeks, in terms of using your broker platform. All that is going to be important. But specifically how you understand option pricing and how they move relative to your position, those are going to be pretty important little topics. I have Alex on the call. I'm kind of doing this also thinking about the recording, but Alex, again, if you need to jump in, perfectly fine to do so. I already told you that before I started recording. All right, so first things first, depending on what broker you use, since I'm an option seller, primary thing that I'm going to be paying attention to is always going to be just implied volatility. So depending on what broker you use, I'm going to show you mine. Going to jump into a trade. First thing that you need to always pay attention to is you need to have liquidity underneath your trade. So whether you're doing shares or you're coming from that space, shares are quite easy. There's normally quite a bit of shares that are being traded underneath any underlying. If you're doing Apple, SPY, Qs, you don't have to worry about liquidity. You don't have to worry about that from an option standpoint either. But with shares, it's generally a lot easier for you to get your fill and you just take the trade. The thing that is really, really awesome about shares trading is that you have a direct scale percentage of what it is that you're making or losing depending on what the underlying is moving at. So let's say we're on Microsoft today and I put $10,000 in this trade just to close yesterday. So I know for today, I'm making a certain percentage amount. So let's say Microsoft is up, it's not updating right here. But let's say Microsoft is up 1%. Relative to your account, you're up 1% if you put your entire account on that trade. So cool. With options, it's not that simple. It's really, really not. And do I recommend you putting on your entire portfolio in one options trade? No, we advise very strongly against doing something like that. I might get into the trade a little bit later, but for right now, I want to do the lesson first, Alex. And then after I'm done, then we can probably take a trade here. Remember, it's not the live trading session. We did that last time and we took a nice trade shorting SPY. But okay, let me continue here. So when we're looking at maybe an option trade, either call or put, instead of doing, a $10,000 trade on a $10,000 account, buying that call or put, a couple of things we want to pay attention to. So you're going to jump into your broker and let's specifically use SPY as an example. Let's do 8DT. All right. So you have a very, very transparent view of what the price it is that you're paying for either the call or put. Same thing with shares. It's very obvious, right? Shares, we know the price of the underlying. Apple is trading at 150. You're going to be paying 150 per share. And now we have partial shares and you can even buy one share. It used to be that you had to buy a lot. So a lot at that time, a couple of years ago, was 100. So you needed X amount of dollars in order to be filled at that price. So with option contracts, what you're going to normally look at is something called implied volatility. And this is important. So implied volatility is a ranking. So depending on if the implied volatility is rich or not, is really when you're going to decide as an option buyer whether you want to maybe take the position or not. So here's just a couple things. This is more, I would say, advanced. As maybe a newer option trader, you can sort of wrap your head around this. When you're looking to take a position when the VIX is relatively high, the VIX is not high at all right now. It's not high at all. But let's just show you a chart here on the VIX. And I'll give you an example. This is going to tie into the rest of the lesson. When you're looking to take a position on SPY specifically, when the VIX is trading very, very high, which we were doing roughly about a year ago when I was shorting the VIX and a couple of people made money. So when you're buying your put or your call, you just need to be aware, not saying that you shouldn't buy calls or puts, but you need to be aware that for that premium, for the implied volatility being as high as it is, you are paying extrinsic value premium or just time premium, which makes the contract more expensive. So in that sense, when you're looking to put on a position, the explosiveness that you would catch on the position might not be as apparent or maybe what you're accustomed to when the VIX is trading at its current low volume. So this, I mean, just recently, right? We were trading at 20, 21 on the VIX for some of you guys that do your 0 to 1 DT trading. Maybe you bought a position and then SPY traded or SPX traded 5 points in your direction. did it very quickly, but you noticed that the contracts were not moving explosively as maybe what you're used to. That's because of implied volatility and the Greeks that are apparent underneath that. So that's going to deal with Vega. It's also going to deal with Delta, and it's also going to deal with some other minute Greeks. But all in all, you don't have to have a fundamental understanding, but you don't have to have such a technical understanding of your Greeks in order for you just to buy your calls and puts. It's similar or analogous to like driving a car. You don't have to know how the engine works in order for you to be a good driver. All right. So I hope that that makes sense. But now let's tie this back into the initial part of the lesson. So when you're jumping into your broker, depending on if you're using TD, Tasty Trade, I know that I'm probably the only one that uses it, but Tasty Trade, whether you're using TD America, Schwab, doesn't matter. You do have an implied volatility rating. So do I normally look at implied volatility when I'm buying my calls or my puts? Not necessarily on an individual strike basis, as you guys are seeing here. If we're looking at just individual strikes, from my experience, the implied volatility on an individual strike for SPY, this is pretty low. I like to sell my positions or take wider stances on my positions when implied volatility is as high as humanly possible. So if you've ever watched any of my videos or ones that I've recommended, normally for an option seller, because I have to talk about that base, we want implied volatility over 25, and I mean as high as we possibly can get on some of the more well-recognized ETFs, like your SPYs, your Qs, all that. So the implied volatility right now for SPY is low. It's very, very low. It's 16, and Qs are pretty low as well. So this should already be sort of a gauge, or it should click in your head. SPY and Qs are running up really nice. We were just out of price action that was sinking on Qs and SPY. So let me give you at least a visual representation here, and then hopefully that this will click. This is sort of fundamental 101 stuff, but it is important, especially when you're looking to put on more meaningful or a lot of positions. So let's check this out. As we were trading all the way down here, implied volatility was a lot more than 16%. It was closer to about 22, 25. So at that point, if we wanted to sell positions, it would be advantageous of us as an option seller to do so. Maybe not so much as an option buyer. However, of course, if you bought your calls here, then you got best of both worlds. You got an explosive move, and then you had volatility contraction that was sort of working in your favor. It was double working. It was doing some double ups there. So you were contracting on your implied volatility premium, but you also got a good amount of explosiveness. So I digress. Now let's go back into the chart here, or not the chart, but the broker. And then if we're looking at just the contracts in and of themselves, again, you guys will never do this, and I don't do this myself. I'm not looking at individual volatility premiums and seeing the difference of 0.5%, 0.25%. It doesn't matter. What does matter is when you're looking at implied volatility premiums as an option buyer or seller, just looking at what it is for the gauge of the month. So if you have at least some sort of sense of where relative implied volatility is for your underlying, if you trade SPY, Qs, IWM, DIA, if you trade any of the commodities, you know that we are at least very volatile or not volatile for that time period. So why is that important? When you're looking to purchase either your calls or your puts, you're going to jump into your shorter time frame. So this is really interesting here. Let's notice some of the implied volatility on the 0 to 1 DTE stuff. Check this out. For contrast purposes, I'm going to jump in and out of the monthlies. If we're looking at the implied volatility premiums for the short DT, they're already significantly higher by about 4 or 5, some as much as 10. I'm kind of calculating here, 12, 15%. Why is that important? Implied volatility premium is going to be a lot more rampant and a lot more violent. To me, I'm picturing like molecules in my head. They're going to be a lot more violent the closer we are to expiration. So that is absolutely makes sense to me, because the option buyers, what they're doing is they're jumping in and out of these trades relatively quickly, right? Even if we sit here for about 2 minutes, you'll see that the numbers are going to be updating fairly quickly. Now let's look at the volume in contrast for some of our 7 to maybe 36 DT. You still have quite a bit of volume, but the implied volatility premium is nowhere near as high as it was for the 0 DT. So cool. Having a fundamental understanding of what you're paying for your call or your put is going to set you a little bit better and help you gauge overall decision-making on how many contracts you want to take. So for me, when I'm looking at something like this, when I'm looking at the numbers, I don't necessarily want to be taking extremely large positions when I'm doing 0 to 1 DT. There's a couple of reasons as to why. Some of you already know. I mean, if you've been here for a while, we understand that we don't want to be doing something like this where we're taking maybe 100 contracts on this position. First, because of the exposure that we have to Delta, Gamma, Vega, all that stuff. And we can lose on these positions fairly quickly. Also, the implied volatility premium, if we just look at the 373 relative to, let's do 7DT right here, it's 24%. Let's do the same strike. It's significantly less here. It's 10% less. So that means that yes, we are paying more premium for this trade, but overall it's less expensive. It's less expensive per the dollar amount that you're paying, because you're going further out in time. So even though you're paying a larger dollar amount here for your contract, $3.26, right? If we went to 0DT, it's going to be like just a couple cents, just $50 or something. All right, so it's $50. All right, it's just more, you're paying more extrinsic value premium on that, and it's denoted here by your implied volatility. Cool, awesome. If that is a little bit confusing, it often is confusing for novice traders, or not even novice traders, just traders in general. There's a lot of math that goes behind this. It's also based on the Black-Scholes model. All you have to understand, we'll simplify it, we'll funnel it. As you start getting closer to 0DT, the contracts themselves, relative to the amount of time that you have, are more expensive. But also, with that being said, they're also more explosive. So you can have a higher percentage gain. It's not necessarily going to equate to dollar amount gain unless you're taking a lot of contracts, but you're also overexposing yourself to risk. So you need to be careful on that equilibrium chart. Yes, you can make a lot of money with some of your shorter time frame trades, but you are exposing yourself to a significant amount of risk. And that implied volatility, the higher that is, the more volatile that contract might be moving there for the short term. So that, in a nutshell, would be just the difference of your different DTs, just looking at your broker. All right, a couple of other things in terms of decision making. You also have relative implied volatility for sort of larger time frames. So something that I like to look at often is going to be commodities. So CL is something that I trade very, very, very often. So as I'm looking at the chart, I'm also going to start basing my decisions off of the relative implied volatility. So if you guys remember, for SPY, it was 16, 18, maybe even 19%. The implied volatility right here for CL is significantly higher. I understand that right now crude oil futures are quite volatile. How can I backpack on that idea? Well, let's jump into the chart here real quick. If anyone has been noticing crude oil, just looking at it, we don't have to really make it too mathematical. It has been very volatile, and it has moved quite significantly in a short time frame, which is going to expand not only our implied volatility percentage, but also the rank. The rank is going to be after a 52-week period. It takes the average of that yearly volatility. So IV rank and IV percentages are not the same thing, okay? All right, so the implied volatility right now, what we would say as an option seller is it's very rich in premium. So that is a good thing. So this is expensive if you are a buyer. If you want to take, let's say 100 puts, not 100 puts, let's say 10 puts, 10 calls, and we want to do that for 35 DT. These contracts, they're at 10x value. So that means that we're not paying $300 for these contracts. We're paying $3,000 per each position, okay? So yeah, their max loss here is $3,450. So these are very expensive contracts. And just looking again at the implied volatility on the position, it is quite high relative to where it has been in the past. So these are certain things, certain decisions that you want to make on whether you do want to sell or buy a position, whether you're trying to catch longevity or trying to catch a sell-off of the move. It's all going to depend on what you decide or what you think is going to happen in the market. In this situation, if I wanted to go short crude oil futures, I would probably look to sell premium as opposed to buy premium, because right now I'm looking and it looks like these contracts might be a little bit expensive, and the move that we might get, we need to have a substantial move, which it's already seen. So we're late to this move. This is a good example to talk about now. We're already late to this move. So whatever sort of expansiveness or that additional premium that I'm paying, it's already there. It's already contracted. It's already fattened up those contracts. So maybe I don't want to be purchasing puts at this point. Again, it's all relative. It all depends on what you think is going to happen. So if I think that we're still going to be selling off, right? This is completely subjective, but let's say I think we're still going to be selling off. What I would do, or what I would try to position myself at, is I would take a short position. So this is understanding the difference on whether I want to buy or sell, right? And I'll try to keep this as most basic as possible. All right, so if I do want to sell on this position, instead of buying my puts, remember, when you're selling, you want to think opposite. So you want to be selling calls because it has the adverse effect. So if I want to sell the position, first of all, I need to make sure that there's adequate open interest. So there is. So if I want to sell, I'll look for a 75, maybe 76.50 call credit spread, and then I'm going to look at my risk reward here. So for those of you guys that are not accustomed to some of the numbers that we have as option sellers, the risk reward is only going to get you at 100% gain at expiration if it is out of the money. So out of the money means that right now we're trading in the money. So the option, the price for this underlying is $76 and it's 76.18. So that means that we need to move lower below the 75 strike in order for me to make money on this trade. It's very different little mindset than you have as an option buyer. So inversely, now let's try to make this as basic as humanly possible. Let's say I wanted to buy the 75 put. This is already going to cost me significantly more than my other $700 position. So I'll purchase this. It's going to run me $3,100. So I already have some exposure, right? I have $3,100 of risk on this trade. So on top of that, I'm going to see maybe what price action is trying to tell me. Let's say I have the opinion that we will sell, or we're going to be selling off more than what we are now. I just want to be aware that if I'm paying for this position, there is a difference between what the intrinsic and extrinsic value on the position might be. This is a little bit, it's not so basic, but I want to show you. Instead of looking at just the implied volatility, we're going to look at something called extrinsic value premium. It's called EXT on my broker. So the extrinsic value premium on this position is, it's all extrinsic because right now we're trading out of the money. All right. So this means that at expiration, if we are not at the $75 strike or below, we stand to lose 100% of the overall premium. This is a little bit more of an advanced concept, but sometimes when we're looking at order flow, I don't know if you guys have ever seen me do this, but order flow, sometimes you see positions come in where, let's say it looks like an institution buys a really large order shorting oil in this example, right? Actually, we'll do SPY because SPY, we'll have it click in your minds. Let's say we do SPY and then we'll talk about extrinsic value here. When you're out of the money, everything is extrinsic. So it should match up. Do you guys see that? 251, 251, 216, 216. It's all extrinsic. So that means that at expiration, if we have not crossed that threshold, you're losing 100% of the value. You don't want that as an option buyer. But as you start going in the money, check this out. The amount of extrinsic value that is in the contract is minimal. It starts to degrade, right? And that's what you want as an option buyer. So sometimes, very often, I get this question asked, why are institutions taking 5,000 contracts at a 445 strike? Well, they don't want that position to be decaying over time. So they're paying that premium, that incredibly large premium that we have in this scenario, in order to have some of that guarantee that even at expiration, the contract will still hold something called intrinsic value. So intrinsic and extrinsic value, the best way that I can explain for someone that is learning this for the first time, I know many of you already know exactly the differences, but just to outlay it for myself, extrinsic value is going to be time value. So it is literally the amount of time that you're giving yourself in order for you to move in the correct direction so that contract can start having something called intrinsic value or actual true value. So that true value is something you will have as an option buyer holding on to that position if you are in the money at expiration. I hope that wasn't too confusing. Now, if you do not have a contract that has intrinsic value, which these do, all these puts have an intrinsic value, every single one. The higher that you go up, the further you are in the money. So the less extrinsic value you're going to have. And obviously these are just going to go up and up and up because there is no theoretical ceiling for your puts or calls if you're holding on to a position. Cool. So if you are moving out of the money, those are sort of the risks that you need to have and be aware of as an option buyer. This is pretty basic stuff. I mean, I'm sure that all of you understand this, but having like a really strong fundamental understanding of option contract pricing, then it helps you a little bit better on your decision making, especially when you're looking to select your strikes. And we'll talk about that here in just a second. So from an option selling standpoint, I won't spend too much time on this. You're going to put on a position, and what you want to do is you want to put an out of the money position where it's all extrinsic value. So check this out. The max profit that you have on the trade is the extrinsic value that you have from selling one leg and then buying the other. So this is all puff. It's literally all smoke and mirrors. Now, if you start to trade in the money, then this does not become smoke and mirrors anymore. It starts to appreciate, which you don't want. So instead of it being $33 at expiration, let's say it's at $60 or $66. At that point, from an option selling standpoint, we're at a loss because we're selling to open a position at $33. Then we have to buy it back at $66. So that's 100% loss at that point. Very often you guys will see me, this is more strategic, it doesn't have too much to do with the lesson, but very often you guys will see me do something like this, where I'm just strictly thinking about risk reward. So I'm thinking of taking these positions as an option buyer. I do this very often on SPX. So as Shafi always says, or even Nick when he does his lessons, if you are looking at appropriate risk reward, I am adopting that mindset, and then I'm bringing that into the option selling part of trading. So we'll do SPX real quick. So we'll do a 70 DT. These contracts are real expensive. So we'll do a 70 DT. If I think that the market will be selling off and I want to hold it for a specific point, check out the risk reward on this trade. Let's do something like this. All right, so the risk reward here is it's not even that bad. But if I want, or I have a strong opinion that we are moving in a direction, then what I will look to do is something like this, because I already am giving myself enough time. Do you see that? It's already enough time. So the risk reward here, I think, in my opinion, would be a little bit better. There's a couple things that I want you guys to pay attention to after I start talking about just another topic before we jump into that, but it's going to be the overarching theme of the further you go out as an option seller, the more extrinsic value you have on your contract. This is a given. Option buyers understand this very well. These contracts are very expensive. Obviously, the closer we're getting to expiration, those contracts are inevitably going to start losing value. If you don't understand this as an option trader, options are designed to be hedges overall. They've been around for 50 years. They were not designed to be traded the way that they are being traded now. They are theoretically supposed to hedge your long positions when you're holding shares. And that's why we see some large positions come in. It doesn't necessarily mean that someone thinks that the market is going to be going down or up in a significant manner. You also have to think that maybe these people are just looking to strategically hedge their position. So I wanted to include that here, okay? So like, let's say you see $1 billion order on SPY. Unless you're starting to see a whole bunch of stack orders, sometimes that might be indicative, but a large order doesn't necessarily mean that someone thinks that the market is going to tank. Remember, they also have cards in their hand that they're not necessarily showing to you. So I just wanted to include that there. Okay, cool. Does anyone have any questions before I continue? I know sometimes I try not to be as technical because this stuff can get real technical. We don't have to be overly technical to understand this stuff. You just need to understand implied volatility is high, I probably want to sell. Implied volatility is low, I probably want to buy. So we're good? All right, cool. Now let's talk about strike selections. This is a very, very important part of the overall trading strategy. The way that I like to go about this, specifically now, if we are in low implied volatility environments, check this out, like we are on SPY, the general consensus for someone like me that likes to sell options, the further that we go out of the money, if implied volatility is low, then the risk reward starts to work against us. So let me show you what I mean. If we're at an 8 DT, and normally if you're watching any video on YouTube or my videos or, Tastyworks videos, what they normally recommend is that you go about 20 to about 30 delta. So delta is going to be a representation of how far you are from the underlying asset where it's trading at now, and it's going to give you a sense of directionality. So let's check out delta here. All right, so what I'm talking about when I say 20 or 30 delta, this is what I'm specifically refraining to. Okay, so a 20 delta is going to put us at 444 here on SPY if I want to sell a call credit spread. So let's just do that. A naked option. We don't do this, and I don't recommend you do this. This is a horrible risk reward. But we're doing a call credit spread here. This is still pretty horrible risk reward. We're looking to take in $20 credit for a max loss of $80. So that means that if I hold this trade at max loss, I have to win the next 4 to 5 trades in order for me to just get back to break even. Okay, and that's assuming that I take all the next 4 trades at max profit. So I don't like to do that. What I do like to do, and what I recommend our students, and just recommend anyone that trades with me in general, is you have to have a happy medium. So we'll talk about strike selections as an option seller, and then we'll do it from a buying standpoint. Option selling, I'll start first because it's more difficult. So for you, you have to determine on what your risk reward appetite is. I like to be anywhere between 50 all the way up to about 120%. So the closer that I go, check this out, because this is kind of tricky for new guys, but the closer that I go, the automatic thought is this is inherently a more risky trade. Now, I don't necessarily think that that's the case. Do you have to be correct on your assumption? Absolutely. So if I go back into the chart and then I do something that's very close to the chest, we'll look at SPY, what it's doing right now. So if I take a trade that's very close to the chest or close to what the at the money strike price is, then naturally we're going to think that it is assuming more of a risky trade. But I don't necessarily think that it is. The reason why is you're being paid for your risk premium. So that risk premium, instead of taking in $20, now you're taking in double that. You're taking in 40. So how many trades do I need to win going forward in order for me just to make back my max loss? I need to win 2 trades as opposed to 4. So you're halving the amount of effort that you're looking to take on the position if you're just going a little bit closer to the at the money price. So at the money is going to be denoted here by that brown line. Cool. Now, you might be thinking, what if I go stupidly in the money? All right, so your risk reward is going to be even better. But you need to, I mean, there's a little bit of a happy medium here. You don't want to go too far in the money, which sometimes I do, because I do have a very strong opinion of what's going to happen. And if that is the case, I think about it like this. Okay, I might lose on the position. I might lose $34. But if I have to take another trade, or I'm going to readjust the trade sometime in the future when SPY is weaker, all I have to do is put on one additional trade in order for me to more than likely make up that loss back on just one position overall. So it doesn't take me too much effort to do so. Now, there is a law of diminishing returns when I do this. If I want to be extremely clever and I want to go to 425 and I'm giving myself just 8 days on this position, this is not a strategic position at all. So I know that the risk reward here is phenomenal. I can see that, right? Almost 10-to-1 risk reward here. This is a great trade to take if you have a very strong opinion that this will be trading all the way down to 425. Maybe you're privy to some information that we're not. Who knows? This trade would be more strategic, and I actually would allow it or think that it is clever if we are giving ourselves adequate time to do so. And I'm going to show you a little trick in this presentation on how you can go about doing that. This is a trick that some of you have seen me do already. Give me 1 second. I need to see. This is a trick that some of you have seen me do already. But if you're giving yourself adequate time, just make sure that you're within the expected move of where you're selecting your strike. So SPX trades via European options. So what that means is that you cannot be exercised early. So this is my candidate for doing this strategy. But let's say I think that SPY or SPY is going to be trading at a specific level, but I want to give myself adequate time. Qs as well. But the expected move, you can get this off any website. You can get this off your broker. Let's say we have an expected move all the way down to 4,200, right? You think that that's a possibility. This is an extreme example, but your risk reward here is pretty good. So how many trades do I need to make up before I'm making my loss for a max loss trade on this? I mean, 25% of one trade. So is this an extreme example? Yes, it is a very extreme example. So this is why I was talking about your happy mediums. You want to make sure that maybe you're not going too extreme, going in the money, and maybe you're not going too far out of the money. You don't want to be doing something like this. Very often traders that are new at this, that are learning how to do it for the first time, thinking that they have a very high probability of profit on this trade just because you're so far out of the money. But just remember, if you lose on the trade, you need to make up 2 or 3 trades in the future. You need to be correct on those trades just for you to make up this loss. So in my opinion, what I'm expressing to you guys is what I normally go for is somewhere around this area. So this is important. And remember, when we were first talking about implied volatility, the higher the implied volatility premium, the more confident I am on this trade, because then you have 2 things working for you. If you have the direction correct, then you also have something called implied volatility contraction that might be working in your favor as well. So even though I'm in the money here, there is always going to be a little bit of extrinsic value. And I'll show that to you here real quick. Maybe not a lot, but there always will be at least some. So there's some extrinsic value that are in these positions. So you see how much they cost, and you see how much can come out of those contracts sometime in the future. Now I'm leveraging something. This is beyond the scope of options trading 101, but there's something interesting here. So even though I'm wrong on the trade, I might even collect some of this premium that I have on the position, okay? Again, you don't want to go knifing all the way down here, right? You don't want to take a 4,000. Like, let's say you do something like this. This is not smart. This is not a smart trade. But if we want to do something that puts us maybe 50 points in the money, I think that that's okay. I'm in one of these trades right now. So yes, I'm losing 10, 20% on the trade, but I just need to win 1 additional trade so I can make up quite a bit of the loss back. So right here, we have $340 for a max loss of 160. This is pretty good risk reward in my opinion. All right, so the same thing is going to be true if we're looking to do this via long positions, right? So we're just talking about shorts right now. Now, let's say for some reason you think that SPY is going to be trading up in the next 3 to 4 months. This is really, really, really interesting for some of you guys after this market starts recovering in a healthy fashion. This is what I do, and this is part of the reason why, you know, I've grown my account over the years, and I wait for these opportunities. I'm not sure if we're in this right now, but at least you guys will have the strategy under your belt here. So let's say we pull back on SPY, and then all of a sudden we're pulling back on interest rates, and we're conducive on the right conditions for us to start recovering pretty healthy in the market. So based on my experience, I like to lean long on the market for longer term. So if that's you, everything that I just said on a short position, we're going to flip that on its head, and then we're going to be talking about long positions. So let's say I do want to do a long on SPY, and the implied volatility is okay. It's not great, but I want to do an in-the-money put credit spread. So let's take SPS as our example. Depending on your time frame, your risk-reward ratio, also what your risk appetite is. Let's say I want to do a long position going into April. So this is reasonable. This is a trade that I would take, no problem. Instead of doing something like this, where the risk reward is not that great, where I'm tying up quite a bit of buying power, I'm tying up $800 to make $200. Okay, I mean, there's nothing wrong with this. If I have a very strong opinion that the market will recover in the next 3 to 6 months, then I can start putting on positions like this where I'm not tying up too much buying power. Let's say I just need to recover an additional 50 points here. Just going 50 points in the money, giving myself 160 days if I want to do the position, I'm tying up $630 to make a max potential profit of 370. So now the risk reward is already a little bit better. This is going to be significantly better when the implied volatility is richer, right? And you're trading higher on your volatility indexes. For SPX, it's going to be the VIX. So in those scenarios, when I am looking at implied volatility has a richness to it, this is where I'm trying to employ this strategy. I'm giving myself enough time in order for that market to recover. Now, is this going to work for every underlying? I like to do this on SPY, Qs, IWM, so on and so forth, more so my ETFs. Not only do we have enough time to recover on the ETFs, and we have an we have an underlying opinion that the markets will trend upwards over time. Also, there's always a good amount of open interest on things like SPY, Qs, IWM, so on and so forth. All right, so that is my strategy. Also, option trading 101 meshed together. Now let's talk about selecting strikes if you're just an option buyer. Let me make sure I'm not going over time here. All right, cool. Now, if you're an option buyer, I'm going to stipulate how it is that I like to select my my contracts, both on the shorter time frame and also on the longer time frame. So let's say for a position that I just lost on, let's talk about TAN, real world example. I'm still losing in this position, but it's a really good example. If I have an opinion that TAN is going to be trading explosively to the upside, normally what you want to do is you want to go for your shorter DTE timeframes. The reason why is that the gamma and the vega that is inherent in those contracts are going to be more explosive. You guys understand this? You're not babies. So this is cool. We got this. Now, would I go necessarily for a 1 DT? I would go happy medium between 8 to about 14 DT. So depending on how much the contract costs for me, then I will make the decision based off that. So I can see that the implied volatility on TAN is quite high. So if you don't know what TAN is, it's the solar ETF. And let's look why TAN is high implied volatility. Well, it's been selling off like crazy, right? So let's look here on the weekly. Things that have been selling off like this, normally their implied volatility is going to be quite high. Now, let's just say we're bottoming out and we're close to the $32 level here, 42. Let's just call this a perfect demand level. So we're on this zone right here. Do I want to either buy a position or sell a position here? Well, it's going to be determined on implied volatility. So now let's jump here and let's just look implied volatility for each individual strike, which I don't do, but it just helps drive the point across. Where is it? Where is it? Implied vol, sorry. So I'm seeing that implied volatility is quite rich. It's quite nice, right? Not like SPY, not like Qs. So in this scenario, if I do want to buy my calls, I know that these calls, they're relatively expensive at this point in time that TAN is trading at. So maybe I want to employ that strategy that I just talked about there on SPX, and I want to do, let's say, a 43, 42.50. So long as that the risk reward makes sense to me, just remember in the back of your mind, right? We are also thinking these contracts also have in them a little bit of extrinsic value. So let's look and see how much that exactly is. The broker does this calculation for you. I'm not sitting and calculating extrinsic value on each position of mine. That doesn't happen. All right, so here we have a little bit of extrinsic value. So on this 43 strike, check this out. It's trading at $1.15 if I were to buy the contract, but it has $80 of extrinsic value. So that is a lot of fluff, a lot. And I know that is a lot of fluff because the implied volatility is quite high. It's closer to that 50% mark. Now, if implied volatility was low, the extrinsic value on the contract would be significantly closer to the intrinsic value, which this is not holding too much of. So all I need is this to trade a little bit more in my favor or direction if I'm taking a put credit spread, and then I'm just letting volatility contraction do its thing. Now, inversely to that is if you are wrong on your direction and then you're in an environment where you're in implied volatility expansion, then you're double screwed at that point. Excuse my French. But of course, what we're doing is we're employing a strategy where if we're setting a stop loss for ourselves, we're basing that decision not so much on all this stuff that I just went over. We're basing that decision off of price action. So very common to what it is that I do for my practices, depending on the trade and depending on the size of the trade. I'll set a stop loss or an alert for myself that if we break below the $38 level, we talked about this in my stop loss lesson. If we break below a very crucial support structure, I'm taking the position off and then I'm looking to readjust sometime in the future. This is recently just done with my NVIDIA trades. I should have taken this trade off a lot sooner than I did. So I took a short position on NVIDIA when we were right at 404, and then it just absolutely railroaded me. So I should have been more methodical in my approach, and I should have taken that position off as soon as we were breaking one of my crucial points here. I would say probably closer to about 424, but I was very, very stingent on my position. However, what helped me make that decision on whether I wanted to hold it or not was the sizing of my position. So since I wasn't too over allocated on it, just took a couple contracts, I was okay with holding on to it. Okay, so that's more strategic. It doesn't have too much to do with option 101. All right, now let's talk about additionally picking those strikes for your buying positions. All right, so we talked about TAN. You guys understood the metrics there and some of the extrinsic value that we have here for your shorts and your longs. I do want to talk about long. We'll use TAN as the example, so we'll continue with that theme. So in this situation, since implied volatility is quite rich, and I'm not too convinced that we'll see a very explosive move to the upside on TAN, I will more than likely lean on the selling side. Let me try to find an example of something that I would buy. I'm trying to think. You know what? We'll do AMD. I think that this is a pretty good example. I was trying to think of TAN, but I'm looking at the chart and I'm like, no one would probably buy calls except me. All right, let's look on the 30. All right, so if you have an underlying opinion that you'll see some explosiveness in the underlying, then you're going, in my opinion, I recommend 8 to 14 DT. I don't love the very, very short DT. So if we're jumping into AMD, and then we're doing 1 to 3 DTE, unless there is something that's coming out, an event or something like earnings, then probably I'll look to take that trade here for 1 DT. But again, the amount of implied volatility that we just have here, it scares me off quite often. That's open interest. Implied volatility. So this is quite high. It is quite high, especially on like a stock that's trading at $100. Okay, cool. And for comparative purposes, we'll go to 36 DT. This is still pretty high too. It's still quite high. But let's say I want to buy my calls. If I want to take a call position here, you want to get snug close to what the at the money price is. What I mean by that, what I mean by snug is if I were to take a 120 strike here, we need a $5 move to the upside for me to already hold on to a contract that only has intrinsic value, which is the goal. That's what you want, right? You don't want to be holding on to something that has a 4% move and we're still not trading in the money because you took the contract based on just the monetary value as opposed to a strategic one. So what I mean by that, and I very, very often see this, is someone will buy a 135 strike that is 36 DTE out just because it cost $88, as opposed to buying a $400 position because it's more expensive. So if you are, if you do trade a smaller account, of course, you're leveraged by how much money you have in your account. So let's say you have a $100 account and you're taking $88 trade. You're already over leveraged. So I understand why some of us make decisions like this. But this should not be the basis of our decision and why we take contracts that are so far out of the money. Just for you guys, I mean, the extrinsic value, this is all extrinsic value, right? I don't need to convince anyone of that. So the closer you are getting to the at the money price, you are paying a premium for having at least a little bit of security. You also have a little bit more risk, but the explosiveness of the contracts is going to be less volatile if you are holding onto a position that has a little bit of intrinsic value. I hope that that makes sense. So when I'm looking to select a strike, let's say for AMD, I don't like the 120 strike, but I also don't like the fact that the 115 strike is $200 more. So I'm going to look for maybe a more granular strike. So granular would be, instead of $5 increments or 5-point increments, we'll do it at a 1-point increment if we can find it. So 8 DT, we are at the 1-point increments. Cool. So I already like the dollar amount here. And we talked about that happy medium between 8 to 14 DT. I don't remember if we had 14 here. We do. All right, so 8 DT instead of $600, the 115 about 288. I already like that. It's already significantly less for my account size. So instead of doing a 115, we're already trading at 115.55. And in 8 days, I think that we have a target closer to 117. So what I do is I always try to calculate, if I think that we're going to get to 117, I'll probably take the 1 point that is just out of the money. So I'll do that. If I really have a very strong opinion that we'll trade past 117 and see even further levels higher, then by all means, I will take the 117 strike. But don't just think that it'll hit 117 and then don't just do it based off of what the broker is telling you. You have to use price action. So levels that I have set for myself in this very real scenario, if I'm jumping out here into the daily, 117 is going to be my resistance area. However, additionally, on top of that, I have a target of 120. So the 117 strike in this specific scenario would make sense to me. Let me show you a strike selection on something that would not make sense to me at all, and we'll use Microsoft. Let's say you want to take a long position on Microsoft. For me, we're already at that, I would say, pretty convincing supply level. So for me, if I were to take a 365 or a 370 strike, if I want to do that for 2 short DTE, I don't think I'm giving myself enough time for me to be correct on that position. Depending on what your opinion is, if you feel that you're overstretched on it or understretched, or you still think that there might be some continuation, it might be worth considering paying more premium for more time on the position, because that's exactly what an option contract is. All right, so let's use Microsoft. And I'll show you what I would select right now if I were to take this position. I like that the dividend date here is on the 15th as well. So we'll do 8 DTE. I like the fact that this is sort of granular, but not 1-point increments, which I normally like. So in this situation, would I pick a 365 strike? It's going to be based off of the levels that we have here. So on the 30-minute time frame for myself, I do have a 366 level. So in this very specific situation, 365 probably would make sense for an 8 DT. Now, if you have an opinion that we're going to trade lower, you're looking at the chart and you're like, that doesn't look like it'll hit the all-time high level here. If I'm going to select the put position, I want to select strategically based off where we are on price action right now. So 361, let's go back here into the broker. And then we'll look at the 360 strike, or maybe even 357.50. I already like, or what's jumping out to me is going to be the 360 strike. Not only are we very close to it, yes, I am paying a premium for that, $100 more than the strike beneath it. But if we do trade into that, we might not even trade too much lower, but so long as that we are in the money, that contract will hold its value quite well, okay? What I wouldn't do for an ADT is I wouldn't overextend myself just because the contract is a lot cheaper, unless something fundamentally has changed where you're looking to take a charge on the position and the thing is selling off like crazy. Then by all means, it makes sense not so much to take a position at 350, but maybe do a 355, maybe even 352. In that sense, yes, by all means. But we never know exactly what the magnitude of the move is. At least I don't know. So that's how I go about my strike selection. All of that was to say that I like to go at least 1 to 2 increments out of the money so the position can start moving in the money. And we'll do a more granular situation here on SPY. I think someone just made a comment in the market. That's why I'm getting some messages. We'll do SPY right here. Yeah, something just happened on the 5. Holy crap. All right. Yeah, something really just happened. All right. So we'll use this as a perfect example for right now. Let's say I want to take a position to short SPY. 435 is probably what I would take. And I would take that for 8 DT. I probably even want to do that now after I'm done with this lesson. So let's do 8 DT and then we'll do a 435. Yeah, I like that. I like that a lot. Not only does it coincide very nicely with what I think can happen here in the short time frame. This is a 15-minute. But I also have my levels set for myself, which is something that I recommend always on Instagram, here, Alpha, in the Discord group. I always recommend that you have your target levels. For me, it's 435, and then as you guys can see, 431. So that 1 to 2 point increment that's out of the money is normally what it is that I'm taking for myself. And then what I wouldn't do, this is just me, everyone to each his own, but what I wouldn't do is I probably wouldn't do a 430 strike. I know that we're paying 2.5 times more the premium, but just remember, if we are trading in the money, that contract is going to significantly hold its intrinsic value more so than any position that you're going to be holding out of the money. And the same thing holds true if you are in a long position. So those are going to be some of the differences on whether I want to take either a long or a short, a selling or a buying position, and how I go about selecting my strikes. If you guys, I mean, there's something interesting to note here. When I'm selecting my strikes, either a call or a put, selling or buying, it's almost the same, right? So if I want to take a short position here, what I'll do for a call credit spread, I'll do something very similar. I'm just going to mirror it over. So I very commonly do something like this. So my thought process is the same. The risk reward here, obviously for the put, is a lot better. But here, the risk reward for my call credit spread, if we move just $1.50 in the money, is already not that bad. It's 150% here. So very often when I'm selecting either my put or my call strike, I'm doing the 1 to 2 point increments in the money, and then I'm seeing how that would go, because the risk reward, in my opinion, makes sense. Bond auctions. So we're getting commentary for bond auctions. That's why we're selling off right now. All right, guys, I know that I went there on quite a mouthful, and some of you probably are in positions right now as I'm talking, but is there any questions that I can answer for you guys? This is something that I would like to be catching. Normally you guys can't see this, but I shut off the TV, but the way that I like to trade is I have CNBC, and then on another screen I have Bloomberg on, so it filters through whatever it is that's happening. I'm short on SPY for my positions. I have a short position going into tomorrow. I'll check on that to see if it's going to win or not, but it's definitely liking this move, that's for sure. So just to sum everything all up, what you want to do for options trading, just 101, because that's the theme of the lesson. For options trading 101, you need to be aware of where implied volatility is trading at. That is probably the #1 thing that I would recommend any student, or you guys just in general, just to be paying attention to, because you need to understand how much you're paying for something. So it's similarly to when you're buying a house, to when you're buying technology, to when you're buying shoes. So you want to have a sense of whether you're paying retail price or whether you're paying sort of a discounted price based on implied volatility. So the higher the implied volatility, the more extrinsic value that contract has. And the lower the implied volatility, then obviously at that point, you're paying less of a premium overall to be taking the position. And then we did talk about strike selections as well. You guys know that I like to be sort of at that plane of at the money, and that doesn't matter if we're in a buying or a selling position. I always consider my risk reward first before I'm looking to allocate any money on any given position. So that was really the overarching theme of today's lesson. All right, guys, if we don't have any additional questions, I'm going to leave it at here. And then we'll see each other in the chat, of course, and then we'll see if we can catch some trades here. We'll jump into the Alpha Sellers Corner and see if there's a scalping opportunity. But all in all, guys, have a great day. Appreciate you, and we'll see each other soon, okay? Take care, everyone.